So if we go back and I ask the question, MMT, how did it start? Well, I have the advantage of having been there more or less at the birth of what became MMT. And in simple terms, this was a trading strategy for hedge funds. Now, it was always very interesting that this was looked at as a branch of Keynesian theory that was launched by someone who was an active trader in international sovereign debt markets. And the question was, or the question that kept being asked is that how do these two things go together? Okay, why is this theory interested in Keynesian monetary theory when really he's a professional financial market trader? Well, it's a very simple answer is that in that period, there was a very common sovereign bond trade that existed that Warren Mosler used at 3i, John Merriweather used at Solomon Brothers, and was used by a number of particular hedge funds. And this was the idea that you could engage in substantial arbitrage profits by using what eventually came to be called the carry trade, which then was just interest rate arbitrage. And in particular, it was borrowing in Deutschmarks at very cheap interest rates, investing in Italian lira bonds, and holding those bonds to maturity. This is what we used to call a relative value trade. Now, if you look at that sort of trade, the only risk that you have is a risk of government default. And as Warren tells the story, he visited a number of people in the Italian treasury to try and determine whether or not that default was a reasonable probability. And his result was that no, governments were not likely to default on their sovereign bond issues. And the reason for that was that as long as they could print the currency in which that bond was denominated, they could always pay the interest on the debt. So that it really was a losing proposition to default on the debt. They were always better off in trying to inflate their way or to create money in order to pay it off. So this is the beginning of the idea behind MMT.